Hi there, we're live at the New York Traders Expo 2018. I'm Stephanie Kammerman and I'm here with Robert Savage. And we were just talking, Robert, about how risk parity was to blame for this past correction, guys. We just want to blame it on anything, right?
That's right. Failure has a lot of reasons.
Yeah,
and
tell us why they would even blame risk parity for that.
Well, there is an automatic function, as we were saying, that there every day,
right.
you know, I get signals to increase or decrease my positioning. So as volatility rises, I'm forced in equities, when the VIX went from 10 to 20 to 30 to 50, from 20 to 30, I'm going to have to cut my position.
Right.
And some of this was violent. Some of these guys obviously are trading more aggressively on how volatility changes, and it is in part to blame for some of that selling. Now, I think that's a little bit of an overstretch, and as Cliff Asness at AQR, who has probably one of the bigger risk parity funds along with Bridgewater, these guys will argue that they just are a touch. You know, maybe there's $3 trillion of folks following a risk parity-like strategy. That's not the $22 trillion of portfolio managed money out there. It's the portfolio managers that, you know, are letting all sorts of factors drive them to sell into a hole.
Right, but did they buy at the hole too? When did they buy?
As volatility decreases, they started to buy. So some of the buying that we've seen over the last week.
Does it measure contango and backwardation?
Not completely. I mean, there are some people look at volatility and try to forecast if it's changing. I'm much more, since I'm daily, more inclined to just look at it now and just trade on that. So overall, you know, the risk parity funds are still down on the month. I, because of my risk management, are probably closer to flat, but it's going to be an interesting time to watch how risk parity survives compared to other strategies, whether they're discretionary managers or CTAs, which have been chopped up in this move.
Yeah, but it's purely based on volatility.
All on just using volatility the only other thing that I would say about risk parity that people need to know is that people get upset about watching the positions grow. And, you know, what factors do you use to allocate your different assets, and how do you pick them? And I pick them on the basis of yield, because this is a long-only strategy. How do you pick stocks? In the last 10 years, if you pick stocks on the basis of dividends, that was a pretty good bet. In the same way, how do I pick my assets? I'm picking the highest yielding bonds. I'm picking the highest yielding stock. I'm picking the highest yielding commodities on the basis of contango. And I throw foreign exchange in there because that's my background. And that gets me the liquidity that you need for a credit portfolio, because otherwise the biggest risk for risk parity has been that liquidity question.
So how can people find you, Robert?
You can find me at cctrack.com. It's very simple.
Awesome. Great stuff. Thank you so much. It's been amazing.
Thank you.